Hello and welcome to the UK Mortgage Market Insights for the week ending the 1st of May 2026. I'm Craig, and as always, thank you so much for being here. If you're new, please do hit subscribe because every week we go through exactly what's happening in the mortgage and property market and tell you what it means for you. There's a few bits to get through this week. We've had the Bank of England's latest interest rate decision land yesterday, swap rates have been on the move, and lenders have been busy adjusting their pricing. It's quite a lot to get through, so let's get into it. Starting with the lender rate movements, and the story this week is movement but without momentum. Now, Coventry Building Society has reduced a large proportion of their rates, which is good news, and that covers both residential and buy-to-let, both new and existing borrowers. So if you're a Coventry customer and you've recently arranged a mortgage with them, it's worth checking whether you can benefit from these reductions. TSB have made some reductions, NatWest are reducing rates, HSBC have cut some of their buy-to-let and residential rates, and Barclays have gone both ways, some up, some down. We also had the Mortgage Works reduce some rates by up to 0.2%. Now, I want to be really clear about this because these movements are not significant. Yes, lenders are trimming here and there, but rates are still sitting way above where they were before the war in the Middle East started. There is no meaningful easing happening. What we're actually seeing is lenders jostling for position, competing to attract the business that they want to write. So rates may well fluctuate for a while yet. But don't mistake a small reduction from one lender as a sign that the market is turning, because it isn't. Not yet. Moving on to swap rates, and these have moved in the wrong direction this week. The 2-year swap rate has gone from 4.127 last week to 4.243 this week. The 5-year has moved from 4.152 last week to 4.219 this week. So both are up, and the 2-year has moved more sharply than the 5-year. Now that's important, because it tells us that short-term money is pricing in more risk than the longer end of the curve. The market is nervous about the near-term inflation, and given what we've just heard from the Bank of England, that nervousness is well-founded. Swap rates are what lenders use to price their fixed-rate mortgages, so when they go up, fixed rates tend to follow. That's the natural direction of travel right now. There's nothing to report with lender criteria changes this week. The focus from lenders again has been really on rate positioning rather than any significant shifts in how they're assessing applications. Do watch this space further though as we get into the year, but for now it's relatively quiet on the criteria front. So moving on to the big story of the week, and that was yesterday's Bank of England base rate decision. The Monetary Policy Committee voted 8-1 to hold the base rate at 3.75%. Now, on the face of it, a hold sounds like nothing has changed, but the detail behind the decision is the really significant bit. The one dissenter was the Bank of England's own chief economist, Hugh Pill. He voted to increase rates to 4%, and the MPC's overall messaging today was notably hawkish. They flagged that higher inflation is coming this year, driven largely by the ongoing Middle East conflict and rising energy prices. And they've made clear that rate hikes remain a real possibility, dependent upon how things develop. So while the base rate hasn't moved today, the mood has shifted considerably. Cuts, which many were expecting earlier this year, are firmly off the table for now, and a rise is not out of the question. That's a very different picture to where we were at the start of 2026. Now, I want to add some context to why that uncertainty isn't going away anytime soon. King Charles visited America this week, as you all know, it's been all over the news, and it was in what many people hoped would be a diplomatic moment. A chance to build some bridges and perhaps calm the waters a little with the Trump administration. And to his credit, the king was measured, gracious and diplomatic throughout. But it doesn't appear to have had the desired effect. The king still wasn't back on UK soil before Trump was back on Truth Social with posts that can only be described as combative. No more Mr. Nice Guy. The storm is coming. Not exactly the language of a man who's been softened by a royal visit. And the reason this matters for your mortgage is simple. The Middle East conflict, energy prices, and now renewed signals of further geopolitical turbulence from the US, all of this feeds into inflation expectations, and the inflation expectations feed directly into swap rates. And as we've just seen, swap rates are already heading in the wrong direction this week. This is far from over, and anyone who tells you that stability is just around the corner and we're going to see loads more rate reductions is being optimistic at best. So to bring all of this together, what does it all mean for you? Well, let me give you my honest take. There has been renewed interest in tracker mortgages in recent weeks, and I understand why. If you believe rates are going to fall, a tracker makes sense. But based on everything the Bank of England has said, I would urge real caution here. I don't personally think that the base rate is going to increase, but I have to be honest with you, I can't guarantee that, and neither can anyone else. The MPC's own messaging yesterday says watch this space. So if you're considering a tracker, please give it serious thought and take proper advice before you commit. Now this brings me on to something that I want to talk about this week, which is the value of good advice. And I want to share two things with you. The first is a story from this week. A couple came to me last Friday evening with an urgent mortgage request. We told them exactly what documents were needed, and they completed our online fact find over the weekend, as well as sending me all the documents requested. We met them on Monday evening, the application was fully submitted by Tuesday, and by yesterday, Thursday, it had been agreed. All that was left was the valuation before the mortgage offer could be issued. Now that alone is a pretty good turnaround, but what makes this one really rewarding is that one of those clients had come out of a debt management plan only 4 years ago. Now we got them a leading rate with a major high street lender at 95% loan to value. A lot of people in that situation would assume that a mortgage simply wasn't possible for them. They'd either not bother trying, or they'd go direct to a lender only to get turned away. The right advice from someone who knows the market changed everything for that family this week, and that is why what we do matters. The second thing I want to share goes back a few years. Cast your minds back, just after COVID, before the Liz Truss mini budget, when the base rate was at rock bottom and mortgage rates weren't much higher. My advice to clients at the time was a 5-year fixed rate is your choice of product as a bare minimum, and for those that could stomach it, a 10-year fix was a very sensible idea. 10-year rates back then were around 2%, compared to roughly 1 to 1.5% for those 5-year deals. Now that's not an easy sell, and a lot of clients chose the 5-year instead, for obvious reasons. Fast forward to now, and those clients who took the 5-year are coming off rates of around 1% and facing rates of around 5%. But I've lost count of the number of those clients who sat in front of me back then and now they're saying, Craig, I wish I'd listened to you and gone for the 10 years. We'd be laughing right now. And they would, because they would be benefiting from a 2-year fixed rate for another 5 years. Now, I'm not saying that I've got a crystal ball, and I don't always get it right. But what both of these stories show is that good mortgage advice can genuinely change outcomes. And choosing a rate based upon the assumption that rates will fall is a gamble that doesn't always pay off. Take proper advice, really listen to it, and then make your decision. Don't listen to people that keep telling you rates are going to drop, because you might make the wrong decision based upon that information. Finally, on the property market itself, it's still very much a buyer's market out there, and buyers are negotiating hard on purchase prices right now. Real discounts are being achieved, and the point I think a lot of people miss is this. A good discount on your purchase can absolutely outweigh slightly higher mortgage rates. If you can get the property at the right price, now is genuinely a good time to be buying. Don't let the rate environment put you off if the numbers still stack up. Well, that's your weekly mortgage market update. I hope it's been useful, and as always, if you've got any questions or you want to talk through your own situation, drop me a message below. We'll be happy to help. Now, if you've enjoyed this video, please do give it a like and subscribe so that you never miss a weekly update again. Thanks so much for watching. I'll see you next week. Take care.